Ladies and gentlemen, please join me in welcoming Professor Errol D'Souza, Director, Indian Institute of Management, Ahmedabad, to deliver the special lecture. The title of the lecture is Fiscal Dominance and Monetary Policy.
Where is it? Full screen. Thank you. It's an honor to be here. Respected Sushil Modi ji, Professor Shaibal Gupta, congratulations on achieving this landmark event and of having 10 years of this wonderful organization contributing to public finance and policy in the state and the country at large. Professor Govind Rao, Professor Anjan Mukherjee, who I consider my intellectual guru, and Dr. S. Siddharth. I think Bihar is actually, Mr. Modi, Bihar is really in very good hands. He is a product of IIM Ahmedabad, and I think if the finance secretary is from IIM Ahmedabad, there's lots that he is going to deliver. So and also Dr. P.P. Gupta, it's a pleasure to be here. People were wondering what I'm doing talking about monetary policy in a conference on public finance. And I'm actually going to be reiterating what is well known to macroeconomists, but somehow been forgotten over the years, that monetary policy is actually a subset of what we used to call intertemporal public finance. That at the end of the day, the two organs of the state, which is the central bank and the Ministry of Finance, deal with different ends of the markets. The central bank is actually dealing on the liquid end of the market, and the state is dealing with the longer end of the market and taxation. And if you look at the old texts on macroeconomics and public finance, they were quite integral to looking at macroeconomic policy. Somewhere along the way, we sort of lost this opportunity to continue looking at it this way. How do I scroll down? Okay, I use this. Okay. A sort of a tradition developed in macroeconomics to look at inflation by just focusing on monetary policy and abstracting from fiscal policy. And for many years we worked in, by looking at things in that way. But the financial crisis called this into question. And there were good reasons to call it into question, because the response to the crisis was actually with joint policy actions. Both organs of the state, the central bank as well as the fiscal authority, did what they could to pump prime the economy back. Okay. The central banks started to do what fiscal authorities do. They started to buy large quantities of private assets unknown in the previous period. And so they were, in a sense, engaging in a dimension of fiscal policy. And as the balance sheets of central banks grew, people started asking questions, about, are these central banks solvent? And if so, is there going to be fiscal support for these central banks? Okay. So all very valid questions that started to come up. Okay. As I said, it to me is a surprise that there was this intellectual turn in history, because essentially monetary and fiscal policy are both different dimensions of public finance. Okay? I'm going to argue in the few minutes that I have that monetary policy looks at the short end of the market, okay, the liquid end as I call it, and the long end of the market is the state and fiscal policy. And that, at the end of the day, if we are bothered about economic outcomes, we should be looking at the coordination of fiscal and monetary policy. Okay? It's well known that central banks, have operational independence. Okay, goal independence depends in some countries. The Ministry of Finance decides what are the goals that the central bank should have, and then leaves the operational independence to them. Okay. But what I'm saying is that the balance sheet of the central bank is not independent of the rest of government. Okay, and there are two reasons for this. Okay. The first is that automatically any operating surplus of any central bank is routinely transferred to the finance ministry. Okay? This is not in question anywhere in the world. Okay? All central banks routinely do this. Okay? And the second one is that the notes issued by central banks, which is their liability, is always guaranteed by the government of the day. And that means that the treasury is actually standing behind the central bank. Okay? And that means that if a central bank, if it so happens, okay, reaches a situation where its financial net worth, okay, is negative, okay, it can be recapitalized by the finance ministry of the day. Okay. And that is not something with limited liability. There is unlimited liability. Okay. The finance ministry can and will have to finance a central bank which runs up into a negative net worth problem. Okay. Of course, there's the flip side of this, okay, which is something which is being argued in India today. Okay. But I'm not going to be commenting too much on the Indian thing except saying a few things later. But what I would like to say is that this is also well known to historians of economic policy and macroeconomists. Okay. A very famous example that I'll spend a minute dwelling on was the fight that happened in 1997 between the ministry. At that time, Chancellor Helmut Kohl was heading Germany, and 1997 was a very peculiar year for Germany because the unemployment rates had reached the highest ever since the Great Depression in Germany. And so there was a lot of call to actually do welfare payments. On the other hand, the reunification that was taking place with East Germany also required a lot of expenditures. Okay? But Germany had entered into the famous Maastricht Treaty, which basically said that there is a limit on the amount of deficits that you can actually hold. And the deficits started to creep up for these two, because of these two events, the great rise in unemployment and the reunification. So Helmut Kohl started to eye the resources in the central bank, the Bundesbank. Okay? And when he looked at the Bundesbank, just like the government of India today is looking at the RBI, the argument that he gave them was that the valuation that you are doing of assets, which was forex assets and gold, is done on a least cost principle. So the assets are valued at the time at which they are bought. Okay? And so that becomes the book value of the asset. But if the market value changes, they don't change the value of the asset. Okay? And so the value of gold at that time was something like 55 billion Deutschmark in the market. But on the books of the Bundesbank, it was something like 13.5 billion Deutschmark. Okay? And so he said that you should actually be revaluing it, to market value principles. And then all that valuation that you get, you should just transfer it to the finance ministry, and the finance ministry then has money to basically plug the deficit, and everyone leads a very nice life. Okay. What he didn't reckon for was that in the bank, even though the governor of the bank supported him, Hans Stettmeyer, he didn't reckon that of the governors of the bank, 6 of them owed their allegiance to another party, and of course the chief economist of the central bank, a person I hold in high regard, Ottmar Ising, was a monetary hawk. Okay? And he actually pushed not to actually allow that to happen. So eventually, there was a big fight for many months, just like is going on in India, but it ended up with the resource transfer not taking place. Okay? So this is common. It's not something that happens only in one country. It is historically known. It happens across the world. And it's surprising that two arms of government are not able to actually coordinate and talk about it and sort of resolve it in a way which is non-conflictual. Okay? So as I said, I'm really going to be talking about these two arms of the state and how they are interrelated. Okay? And with one being the short end arm of the stake and the other the long-term deep pockets arm. Okay? Let me not spend time on this. Okay? The reason central banks are looking more and more like fiscal authorities is also because they now started to pay interest on reserves. Okay? And this is very much something which is making them look much more like a fiscal authority. And sovereign debt troubles, which have been happening in all parts of the world, specifically in the euro area, okay, are reminding every country that there is a fiscal limit, okay, beyond which debt is not assured. Okay. And that means that fiscal expectations can actually also be drivers of inflation and not just monetary policy per se. Okay. Finally, aging populations in large parts of the world, okay, have also created fiscal stress. Okay. And any projected debt figures that you see, whether you see them from government organizations or by private academics, okay, you find that this is a ballooning problem. Okay, that debts are going to be growing even in advanced parts of the world. Okay. At one time, when you talked of debts and deficits, you talked of Latin America or you talked of Asia, South Asia. Okay. Today, the problem is the reverse. Okay? Many of the high debt deficit countries are actually advanced economies. Okay? So let me go about my business by presenting first the central bank balance sheet. Okay? And I'm basically taking a very simple balance sheet. I'm not looking at its operating costs. I'm assuming those are zero, etc., just for simplicity. And so it has two assets, as we well know. It basically holds government securities and it has forex reserves. And on the liability side, there is the monetary base. Okay? Now, that means, if you look at the financial net worth of a central bank, okay, it can very well be negative. Okay? That's nothing to be surprised about. Okay? It's quite possible. All it requires is that if there is negative net worth, that you are actually going to raise seigniorage in future by issuing more nominal currency in the future or in the present, okay? Provided you still are trying to keep inflation under control. Okay? If you look at the government's financial balance sheet, okay, then we will find all governments' financial balance sheet net worth of most governments is always negative, okay, by design. Okay? They basically issue debt. Okay? And the debt is either held by the central bank or it is held outside the central bank. And so the financial net worth is going to be negative. Okay? But if you consolidate it, okay, which is what I've done, I've just taken the two balance sheets together and consolidated it in the one below, then you find that whatever is the debt that the central government has issued, okay, gets cancelled out by the holding of that debt by the central bank. Okay? And so at the end of the day, the financial balance sheet of the state is nothing else but the foreign exchange reserves, which are the assets. So those are the assets that are being held. And the liabilities are the monetary base and those government securities held outside the central bank. Okay? And that is really what we should be focusing on as policy makers. We should be focusing on this. This is the budget constraint that matters for the economy. Okay? Not the separate balance sheets of the two entities. Okay? And that means that there is a requirement for coordination. There is a requirement for them to talk to each other. Okay? We're not saying that they should listen to, they should necessarily follow, one should follow what the other says. But unless you coordinate, unless you talk about macroeconomic policy and what you're trying to achieve, and you have similar goals. Your goals are output inflation. The central bank may be bothered about financial stability in addition, and the finance ministry may be bothered about redistribution in addition. But apart from that, they do have common goals. And to achieve those common goals, there is a requirement that there should be coordination across these two entities. Okay? It cannot be that one treats the other in isolation and works accordingly. And that, I believe, is the source of large parts of problems that occur in India as well as in other countries. Okay? So I won't take you through the technical details. Okay? If you actually look at the budget of the government, so it's just government expenditures minus whatever tax payments it gets and operational transfers. Let me not take you through this. It's just a way of actually, it'll just put you off. It's meant for a more technical audience. Okay, it's something that I would be presenting, later to a more technical audience as well as to some people at the RBI. But so the issue really is, as I said, that the financial deficit that matters is the financial deficit of the government and the central bank. Okay, and somehow we don't focus on that as we should be. Okay, and what it means is that if for some reason the debt issued by the central bank, okay, is sort of the value of that debt which has been issued is less than is greater than the present value of surpluses that are going to happen in the future, then there is a hole in the budget, right? And the intertemporal hole in the budget can only then be actually plugged if there is going to be some rise in taxation in future, or there is going to be some increase in real money, real base money or seigniorage. Okay? Without that, you'll either have inflation or you're going to have defaults. Okay? So both are clear implications of the constraint. This is not something which is unknown. Okay? I mean, here's a quote from many years ago, okay, from a person who is a well-known macroeconomist. Okay? The central bank is always an agent of the state. It is not an agent of government, right? But it is an agent of the state. And that means certain very clear principles. I believe a large part of the problems that occur is just not clear accounting that is taking place when we look at the central bank and its transfers. Okay? So if you think of the operational surplus of the RBI or any central bank, which is going to be transferred to the government, okay, this is money that the RBI gets through financial transactions, through income on its financial assets. This is not money received because of some production activity or because of some income distribution. And to the extent that it is income from a financial asset, okay, when you transfer it, it can be used to finance a deficit, but it cannot be used to reduce a deficit. Okay, so it's a very important point which is being missed in the debates that are taking place in India today. Okay, this is really, a problem of bad accounting. Okay, if we know this, I mean, public finance people have been speaking about this in India for a long while, about how in the deficit figures should disinvestments be part of the definition of the deficit. In a similar way, any operational surplus transferred by the RBI cannot be treated as something which is reducing a deficit. It's not a revenue item for the state. It is actually an income from an asset, and therefore it can be used to finance a deficit, but not to reduce a deficit. I think it's a very important accounting principle that we do not follow. Since we do not follow, it creates problems even for the central bank, because if you do not follow it, the central bank can be incentivized by the finance ministry to think more about operating in such a way that transfers to the ministry increase rather than focusing on its goal of affecting inflation and output. Okay? Think of, for example, if the central bank were to sell gold or forex assets and get some money out of it and then transfer that to the government. Okay? Again, I believe this is not something that can be used to finance the deficit. Okay? This is, to my mind, nothing other than an increase in the equity of the government in the central bank. Okay? It cannot be treated as when you sell, because it's a national asset. Yes, the central bank is the bank which actually operates the national asset, but given that it's a national asset, a sale of a national asset can only be offset by a rise in the equity of the government in the RBI. It cannot be treated as it's being used to finance a deficit. Okay? And finally, I must make a comment, tongue in cheek, about demonetization. Okay? Because if you decide as a government, okay, that you and Reserve Bank, if you decide that you are going to withdraw currency in circulation, you are getting rid of a liability. Okay? And the moment you get rid of the liability on the balance sheet, according to me, you automatically should be saying that the equity account of the government is credited. You can't treat that as a transfer that you are going to use to finance a deficit. Okay? So I think we've not got our accounting correct. Okay? And if we do our accounting appropriately, like good economists, like good public accountants, we would not have got ourselves into the mess that we have. Okay? And this happens across countries. I believe there is a political economy even to accounting. Okay? And there are good reasons why we want to do things in a certain way, because we want to actually have this flexibility to play with resources rather than, very clearly assigned resources where they should be named and assigned. Okay. Okay. Just to remind ourselves of this coordination problem between central banks and finance ministry, I'd like you to take a look at this graph, which is basically showing us the major assets of the RBI. The red is the domestic assets, and the blue is its forex assets. Okay? And if you look at it, you will see that there was a year, 2004, where suddenly there is no red. Okay? And at that time, the RBI had only forex assets. Okay? And that was a very tough time for the RBI. Okay? That was a time when capital flows were coming into the country in a large way. The RBI intervened to stop the appreciation of the currency, and so started to pick up, forex reserves. When it got the forex reserves, it started to realize that money supply was growing out of hand, its inflation target was being hit, and so it started to sterilize. So it started to sell bonds. And one morning it woke up to find that it had no G-Secs on its balance sheet. Okay? At that time, what do? Okay, that's where the state bails you in. And the state did. The state actually started market stabilization bonds. Those of you all who remember that period, that very recent period of our history. And the market stabilization bonds sucked money out of the economy, and the money was parked in the RBI, and the state paid interest on behalf of the RBI. Okay? And that's coordination. Okay? And that's how we managed to get out of that period. So there have been periods where the state bails out the RBI. There have been periods, on the other hand, where the RBI might help the state. Okay? But there has to be coordination. There has to be talk. Okay? A lot of, in monetary theory, we talk about, it's not just about open market operations that the RBI is involved in, it's also about open mouth operations, okay? And it's important that you actually have this dialogue. Otherwise, it's very, very difficult to ensure that you are going to get outcomes which are good for the country. Okay, let me skip this. Okay. Now, let me just spend the next, how much time do I have? I don't want to run out of. Okay, no one's answering me, great. Open budget constraint, okay. So, in the next part of the presentation, I just want to build on this theme slightly, okay. And what I'm really saying here is that when the government issues debt, okay, we don't normally ask ourselves the question about, how do you actually value this debt, okay? And if you ask yourself that question about how you value the debt, then you'll think of it as debt is issued just like any financial instrument. And any financial instrument's price should just be the present value of expected returns from that financial instrument, okay? And if that is the case, then what is the return? What is the price of debt? The price of debt is the present value of future surpluses from the budget, because how will the debt be repaid? It can only be repaid if there's going to be a surplus in future. Okay? And that means it leads to a very interesting insight. The insight is that if you think about it, okay, I'm not going to take you through the model again. I'm sorry that, all this is creeping in. I didn't have the time to actually, redo the slides, okay? But what I'm really saying is that think of, I must be having a statement here. Yeah, the value of an asset is basically the expected present value of future cash flows. In which case, for bonds, the value of the bonds, real value, is the expected present value of primary surpluses in future, okay? Now think of if the bonds are issued, and if the expectation is that there's going to be no surpluses in future, okay? Then what happens? The only way that equation, the bonds have already been issued, the nominal value of bonds is known today. The only way that equation can be satisfied is for prices to rise, okay? And that means that when the government is spending in a particular way, it is also affecting inflation. And so inflation is not just a monetary phenomenon, okay? Inflation, I mean, this is again well known to macroeconomists. Sargent and, reminds us often and saying that, inflation may be a monetary phenomenon, but issue of base money is always a fiscal phenomenon, okay? And basically what you're saying is that fiscal policy is also impacting on inflation and not just monetary policy, okay? And if that is the case, then if you are going to give the central bank the target for inflation, okay, then it can only manage that target provided fiscal authorities are actually appropriately managing the fisc, okay? If the fisc is going to go out of hand and future deficits are going to continuously grow, you're actually going to create expectations of inflation from the fiscal side, when on the monetary side, you're trying to hold in those inflationary expectations, okay? And that can be serious for a central bank, okay? So therefore, the assumption that is required for monetary policy to work is that if there is going to be government debt in a period, the expectation is that the government is going to, at some point, be able to pay that back. And if that expectation does not fructify, okay, then you're basically you're not anchoring fiscal expectations and you're not anchoring inflation, and that can be problematic, okay? So for an inflation targeting regime to work, which is what India works with, you need to anchor fiscal expectations as well, okay? And when central banks are given a mandate to control inflation, it requires the fiscal authority a mandate to ensure that deficits lead to surpluses, okay? And therefore, all that I'm saying here is fiscal rules matter. Without fiscal rules, you're going to have a problem of managing even inflation, okay? And you could do fiscal rules. Govind is an authority on this. You can do fiscal rules in many ways. You can have independent fiscal councils. Many countries have dealt with it in many different ways. Most of them don't have a bite, okay? But that's another issue altogether, okay? So that's the second part of what I wanted to say, okay? And finally, what it means is that when you're looking at, debt management, okay, typically the government of India and most people basically say the function of debt management, okay, is to minimize the costs of meeting government's needs, taking into account the acceptable level of risk. I always say add, and also that debt management is consistent with the aims of monetary policy, okay? Because if it is not, then you're leading to fiscal expectations of inflation, and that can actually undermine debt management as well as monetary policy. Okay. I believe that because there has been no coordination between the central bank and the fiscal authority, both are playing a game of chicken, okay? And that can actually lead to disaster for the economy, okay? That's really the essence of what's been going on in India in the most recent past. Game of chicken is well known to those of you all who are not not gone through an economics program. It basically says that, this is a game that used to be played by teenagers. So they are basically, going head on against each other down a narrow road in their cars, and they meet at a junction, and then they have to decide whether they swerve or they actually turn, okay? Now, if you go straight, okay, you have not chickened out, you had the nerve, and the other guy swerves, and you actually, are the guy who wins. You held your nerve, the other guy didn't. If you swerve because you lost your nerve at the last minute, and the other guy basically, goes straight, then, he wins and you lose. If both go straight, then you crash, okay? This is a well-known game. And the solution to this game, okay, if people are looking for solutions, is basically to say, okay, that there are two solutions, okay? If I look at a very restricted set of solutions, okay? And this is basically what, because anyone coming up on that motor path is basically saying, I should hang on and I should not swerve because the other guy will not want an accident, and so he should swerve, and the other guy is thinking similarly, and so at the end it's just a loss of nerve which makes one swerve. So anything could be an outcome. Either you swerve or the other guy swerves, okay? Similar thing is happening between the fiscal and monetary authority, okay? Should you tax finance or debt finance, or should you accommodate or not accommodate? And both are basically playing a game of chicken, okay? And I believe that is bad news for the economy, okay? So let me sort of, there are many instances of this, okay, where, finance ministers have actually said very clearly that, in fact, this happened when I was part of the Technical Advisory Committee on Monetary Policy, and I remember we were debating whether to go for an interest rate hike or not. And 2 days before, the finance minister called a press conference and announced that I'm confident RBI will reduce rates. And we said, what the hell, what's our job here? He's already announced it, So he was playing chicken with us, okay? So as you can well imagine, we also played chicken. We didn't swerve, we went straight, okay? And that annoyed him, okay? So that is what was good. Unnecessary. If there was a coordination, it could have been done much better, okay? It's happened many a time. We know this very well in India, okay? Chidambaram also did it with the RBI at that time, okay? And these are well-known quotes, okay? So I need not talk about them. He basically talked about how, if he has to walk alone, he'll walk alone, okay? Bad news. Both should be walking together. Both should be headed in the same direction, okay? I believe, therefore, and let me end with this, let me not, harp the point too much, that both monetary and fiscal policy, okay, is well known, are actually two ends of macroeconomic management, okay? In intertemporal macro and in intertemporal public finance, okay, they're actually the liquid end and the long end. And therefore, they require coordination, okay? I argued that, if you do not do the coordination, there could be bad outcomes for the economy. You could have inflation coming out because of fiscal expectations and not just monetary expectations. And then it's very difficult to manage an economy, okay? I'm not saying a central bank should not be independent. Please be careful about interpreting what I'm saying, okay? But it doesn't mean that you shouldn't have that conversation if the finance minister calls you on the line, okay? The governor should very much have that conversation, okay? Finally, what I'm saying also is that somehow we don't focus as public finance people enough on the accounting principles. I believe if the accounting principles are done right, none of these debates would actually happen, okay? And that we would actually be living in a very different, much better world. Thank you.